Hi everyone, welcome back to the channel. So today we'll be continuing with the valuation basic questions. As of now, we have covered 20 questions and 21 question onwards. Today we will cover and we will try to complete it today only. And after this, we will start with valuation advanced questions. I hope you are enjoying the series. So let's get started with question number 21. Question number 21 is asking, what do you actually use a valuation for? So let's break this down carefully. So the question is, what do you actually use a valuation for? And in investment banking and in finance generally, valuation means estimating how much a company or asset is worth. The question is asking, once you calculate a company's value, what do you actually do with it? And why is it important? If we understand the what the answer is saying, so usually you use it in pitch books and client presentations where when you are providing updates and telling them what they should expect for their own valuations. And this means that when investment bankers meet with clients, for example, a company thinking about selling itself, buying another company, or raising capital, they prepare pitch books, presentation documents showing market analysis, recent deals, and what their company might be worth. So, valuation is used here to show the client an estimated price range uh, their company could sell for, or they might have to pay it if they acquire someone else. And if we talk about an example, if a tech company, if a client is a tech company and wants to go public or sell itself, the banker shows um, that based on comparable companies, we can estimate the valuation of this much $1 million or $1 billion, and this helps to set an client. This helps the client setting an explanation expectation. Uh, it mm, it also used right before a deal closes in fairness opinion, a document a bank creates that proves the value their client is paying or receiving is fair from a financial point of view. So what does that mean is when a deal like acquisition or merger is about to close, the investment bank issues something called a fairness opinion. This is a formal document saying, based on our analysis, the price being paid is fair. So fairness opinion. It's meant to protect the company's board of directors and from shareholders' lawsuit because it shows that the decision was based on a reasonable financial analysis, not arbitrary choices. So here valuation is just to justify the transaction price. And if we read the valuations can also be used in defense analysis, merger models, LBOs, DCFs, because terminal multiples are based off comps and pretty much anything else in finance. So this means that valuations are used in many analytical contexts also. So like defense analysis means when a company is a target of a hostile takeover, bankers use valuation to argue that the offer is too low and thus should be rejected. Merger models means to see whether combining two companies creates or destroys value. LBO models we have discussed earlier also leverage buyouts to determine what a private equity firm should pay and what returns they can get. DCF, discounted cash flow models, the terminal value, the company's far into the future value often depends on valuation multiples in DCF. uh, Taken from comparable companies. So basically, valuation is a core input or reference point in most types of financial models and decisions. I hope we have discussed everything about what do we do with the valuation. So let's move to question number 22. The question number 22, let's break it down clearly and intuitively. So question is, why would a company with similar growth and profitability to its comparable companies be valued at a premium? So this is a valuation question from investment banking and equity research. Normally, when you value a company using comparable company analysis, you look at similar companies' financial metrics like revenue growth, EBITDA margins, etc., and apply their valuation multiples, which are enterprise value to EBITDA, price to earnings, etc., to your company. If two companies have similar growth and similar profitability, you would expect them to trade at roughly similar multiples. So the question asks, why might one of them be valued at a premium anyway? So the core idea here is the company can trade at a premium, higher multiple, even with similar financials, if qualitative or non-financial factors make it more attractive to investors. So these factors could signal lower risk or higher future potential. Now let's go through each of the reasons listed. So the reasons could be recent strong earnings beats expectation. This means that the company has just reported earnings well above expectations and its stock prices has risen recently. So even if the company's historical growth and profitability look similar to peers, its latest performance suggests that it's doing better than expected. This could be a reason. Investors might believe that a strong performance will continue, so they are willing to pay more for the stock. This raises the valuation multiple. If we think about from the competitive advantage not reflected in financials, this is the second point. It has some type of competitive advantage not reflected in its financials, such as key patent or other intellectual properties and financial metrics. If you think about it, financial metrics like EBITDA or revenue shows current performance, not future potential. A company with valuable intellectual property, technology, brand strength, or patent may be positioned for stronger future growth, and investors price in that future advantage, leading to a premium valuation today. So that is one more reason where a company, other one company, even though they are from the same, they are the same peer groups, but one is valued highly and another one is valued um, just normally. Uh, so if we think from favorable legal and regulatory outcome point of view, it's the point number three explains that it has just won a favorable ruling in a major lawsuit. So what does this point infers is that this reduces uncertainty and removes a potential risk to earnings. So and lower risk means higher investors' confidence uh, and higher valuation multiple. So favorable ruling also represents that the company may now also have access to new markets or products previously restricted by the lawsuit or whatsoever was the reason for the lawsuit. So now, from the investor's point of view, this point three is also favorable. And in the market leadership context, so it is a market leader in an industry and has a greater market share than its competitors. If this is the case, being a market leader often means that better economies of scale, uh, a stronger brand recognition, pricing power also, and more stability in downturns. So investor reward these trades with a premium as they indicate a lower risk and better long-term prospects, even if the short-term financials look similar to peers. So this might be the case. This might be these 4 points might be the explanation for why one company is valued more and another company is not valued that much, even though their financials were similar. And in short, if we talk about this, a company can trade at a premium even if with similar financials if investors believe it's less risky and has great future potential than its peers. And due to qualitative factors like leadership, intellectual property, or recent strong performance, also. So this explains everything. Let's move to question number 23 now. So question number 23, what are the flaws with public company comparables? This refers to valuation method called public company comparables or public comps, one of the three main valuation methods in finance, along with precedent analysis, precedent transactions, and DCF, discounted cash flow. We have discussed it previously also. Uh, the public comps involve finding publicly traded similar companies similar to one you want to value. Same industry, size, growth, risk, etc. So looking at their valuation multiple like enterprise value, EBITDA, price to earnings, or enterprise value to sales, and applying those multiples to your company's financial metrics to estimate the value. So this is what public company comparables means. So, the answer and the explanation given in the question is that no company is 100% comparable to another company. So this means that even companies in the same industry can differ in size, growth rate, geography, profit margins, or capital structure. For example, if you are valuing a small regional airline, you might compare it with Delta or United, but those are global giants. The comparison is not perfect. And what does this means also is that their differences mean the multiples you use might not reflect your company's true value. And the second point here is that the stock market is emotional. Your multiple might be dramatically higher or lower in on certain dates, depending on the market's movement. This means that the stock market often moves based on investor sentiment, macroeconomic news, or market trends, not just company fundamentals. Uh, so market sentiment in common terms, it's called market sentiment, and this could be one reason. If the market is over optimistic, uh, comparables might be overvalued, and this is the main reason for creation of a bubble. And bubble creating a bubble is very high in is in news these days because of the tech bubble which is being created because of AI. Valuations are pushed because the market is very optimistic with AI, artificial intelligence, and it's creating a bubble in the tech space. And in 2008 crisis, if you remember, there was a real estate bubble also. So if the bubble is created by the over optimism of the investors. If the market is fearful, comparables may be undervalued, and that's a downturn or a crash. So bubble and a crash. During tech booms, software as service companies, SaaS companies might trade at 20x of their revenue or more than that. But during a market crash, the same companies trade at 5x of their revenue or 5, 3, 2. So the valuation depends heavily on the timing. So how the market is doing. So what is the market sentiment? And is there a bubble or a crash going to happen in the future? So this is how the public company comparables get influenced. So valuation depends heavily on time also. And the third point here is selling prices for small companies with thinly traded stocks may not reflect their full value. And yes, small public companies often have low trading volume, meaning not many investors are buying or selling their shares. And a few traders can use big price swings, which can make their stock price unreliable. So only a few traders can use big price swings. Uh, and the market may also undervalue those companies due to low visibility or lack of analyst coverage. So share price for a small companies with thinly traded stocks may not reflect their full value. Yes, if a company shares really trade, its stock price might drop sharply after one sale. But that doesn't mean that the business is not worth less fundamentally. And the bottom line, if we think about it, that public comps are easy to calculate and reflect real market sentiment, but they are imperfect because markets are emotional, companies are unique, and small cap can also be unreliable. So this one states that the market is emotional, companies are unique, market is emotional, companies are unique, and small cap companies can be unreliable. And yes, always think from a perspective of gray area. It's not right or wrong, but it's somewhat right, somewhat wrong. Not black and white, somewhat black, somewhat white, but sometimes gray. So let's move to question number 24 now. Question number 24 is, how do you take into account a company's competitive advantage in valuation? And this question is how to reflect a company's superior position. For example, brand strength, patents, market dominance, cost leadership, etc. in your valuation analysis. If a company is better than its peers, its value should be higher. But how do we actually model that higher value? And the given answer here is that look at the 75th percentile or higher for the multiples rather than the medium. Add in a premium to some of the multiples, use more aggressive projection for the company. And in practice, you really do all of the above because these are just the possibilities. So let's go through each one of them. So using higher multiples, that is 75th percentile instead of medium, is this means that when you use a comparable company's analysis, uh, you often look at multiples like enterprise value, EBITDA, enterprise value to EBITDA ratio, price to earnings ratio, or enterprise value to revenue ratios for a peer company, for a peer group. And the medium multiple represents an average company. And 75th percentile represents a stronger than average company. If your company has a clear competitive advantage, that is higher margins, strong brands, faster growth, it makes sense to assign it a higher multiple because investors would be willing to pay more for each dollar of earning. So instead of valuing it at a median, you might use a multiple, 12x, 13x, 15x, rather than using a median. And the second point here is add a premium to some of the multiples. This means that this is conceptually similar to the first point only, but instead of choosing from the upper end of your range, you might explicitly add percentage premium. For example, if an industry's average enterprise value to EBITDA is 10x, so you might apply a 20% premium and you can make it 20, 12x. So this is another way of capturing the advantage. You are saying this company deserves a higher multiple than its peers based on the business model. And the third point here was use more aggressive projection. So if you are doing a DCF, the discounted cash flow valuation, you do not use multiples. You project the company's future financials. If you are doing a DCF, and projections are done only in DCF, so a company with competitive advantages might grow revenue faster, maintain higher margins, and require less investments. So instead of changing the multiple, you would reflect the advantage in the forecast, higher growth rate, you can use that, higher profitability, more stable cash flows. This naturally will lead to higher valuation in the DCF. The note here is that in practice, you really do all of the above. This means that in the real world valuation, in this means that in real world valuation work, you usually pick one or two ways to reflect the advantage, not all of them. Otherwise, you might double count the effect of the overvaluation, or you will be overvaluing the company. Don't be. I mean, there is one more thing which is about biases, which we will study later on. So biases means, let me just give you a quick introduction about biases. Is if you are a Apple user or if you are a Samsung user, so you will be biased toward that product. So it will be very difficult for you to make a decision without without no you will be very it will be very difficult for you to make a decision without favoring the circumstances, because you will be optimistic with the product because you are a user of you are a consumer of the product. Or if you are if you hold the securities, then you will be over optimistic about the products. So the biasness concept, we will study about it later on. So you actually have to be overcome your you actually have to overcome your biasness first. Then only you will be able to do justice in the valuation. So, if, for example, if you already predicted higher growth rate, you should not also give a larger premium on the multiple. So that would be redundant. So I hope this was clear. And about biases, we will discuss later. Uh, Biases actually majorly refers to the psychology of the investor. Uh, you're liking about the product, and that actually drives your valuation also. So you actually have to, and that's when the consensus valuations come in. What everyone else in the market is saying. So you can refer to that. Uh, Take a reference as a reference point, and then you can uh, do the valuation of the company of your interest. Question number 25. Let's move to that. So question number 25 is do you always use the median multiple of a set of public company comparables or precedent transactions? The question is about valuation using multiples, specifically comparable company analysis, comps, and precedent transaction analysis precedents. And in these methods, analysts collect a group of similar companies or precedent transactions or and look at valuation multiples like enterprise value to EBITDA, enterprise value to revenue, price to earnings. These multiples tell you how the market values similar companies. So once you have all those multiples, you often calculate summary statistics. The 25th percentile, lower, higher, median, 75th percentile, upper. Then you may decide, after that, you decide which multiple to apply to the company you are valuing. So the answer explained, if we try to read the answer, that there is no rule that you have to do this, but in most cases you do because you want to use values from the middle range of the set. So this means that the median is often used because it represents the typical value in your comparable set. Using a median avoid the influence of extreme outliers. Companies that are much larger, smaller, or growing much faster than the others. So using a median is a conversion is a it's convention, not a strict rule. So using median is a convention, not a strict rule. But going forward in the solution, if a company you are valuing is distressed, is not performing well, or is at a competitive disadvantage, you might use a 25th percentile or something in lower range instead, and vice versa if it's doing well. And this means that basically you adjust your multiple choices based on how the target company compares to the peers. If the company is worse off, I mean, low growth, high risk, financial distress, it deserves a lower multiple. So you might use the 25th percentile, the lower end of the range. If the company is better performing, high growth, market leader, strong margins, it deserves a higher multiple. So you might use the 75th percentile upper end of the range. And this adjustment ensures your valuation reflect relative performance, not just blind adherence to an average or median. To summarize, the median multiple is usually used because it represents the middle typical value. But you can and should adjust based on the specific company situation. Underperforming, if the company is underperforming, use a lower percentile multiple, and if the company is overperforming, you can use a higher percentile multiple. And there is no rule; it's judgment call based on context. So let's move to question number 26. Question number 26. The question here is that you mentioned that precedent transaction usually produce a higher value than comparable companies. Can you think of a situation where this is not the case? And this valuation interview question commonly asked in investment banking and corporate finance interviews. It's testing whether you understand why different valuation methods tend to yield different results, and whether you can think critically about exceptions to the general rule. And the general rule, in most cases, precedent transaction merger and acquisition multiples, we have discussed this previously, produce higher valuation. Comparable companies, trading multiples. Um, and why is that? Because in acquisition, the buyer usually pays a control premium. If you are acquiring some company, you will be paying a control premium. The control premium is the extra value to gain full control of the target company. And the buyer may also pay a synergy premium, expecting cost saving or revenue benefits after the merger. So typically, transaction multiples like enterprise value to EBITDA and enterprise value to revenue are higher than trading multiples of similar companies. And the exception, the situation in the answer, the situation asks for situation where it's not true, when precedent transactions might show a lower value than comparable companies, and the answer gives one situation. Sometimes this happens when there is a substantial mismatch between the merger and acquisition market and the public market. For example, no companies have been acquired recently, but there have been a lot of small private companies acquired at extremely low valuation. Um, if we unpack this thing, uh, try to understand this thing, if public markets are strong and investors are optimistic, public company valuations, trading multiples may be high. Meanwhile, if merger and acquisition markets are weak, few buyers, uncertain outlook, any recent acquisition might involve small private companies sold cheaply. So these low transaction multiples can end up being lower than the multiples for comparable public companies. So in this case, precedent transaction will be less than comparable companies analysis. And we have discussed previously merger and acquisition. Just understand this thing that in merger and acquisition, the buyer has a tendency to buy it for more because of the control premium and because of the synergies involved in the business. So merger and acquisition is involved with precedent transaction and comparable companies, as the name suggests. When we are comparing companies across peers, you are looking at a chart. So you are doing a relative valuation and you are comparing companies across. So you are pricing in these companies when you are doing a comparable companies. So pricing, and there's a difference in between pricing and valuation. Think about it. Even though we are calling it valuation, but here we are pricing across companies, across the peer companies. So this is what the major difference is, and this is what they are asking from different angles. The How much clarity do you have regarding these things? So let's continue with the question. In other situations where this can happen is few possible examples can be there, like distress sales. Just if there is a distress sale, companies sold under financial pressure often go for very low prices, and marking timing, the timings also. So timings matter most. So market timing differences. If precedent transaction occurred during a downturn, or the comps are being valued at a booming market. So if the market is not favorable and we are selling or buying a company, so that might affect the valuation. Difference in company sizes and quality. If the transaction comps, the transaction comps are much smaller or riskier than the public comps. So difference in company size or quality also matters. And the key takeaways from this question was that the precedent transaction comes, so precedent valuation will be greater than the price. The precedent valuation will be greater than the comparable company's valuation, and it's usually true. But market conditions, timings, and sample selection can flip the relation. So there are exceptions to almost every rule in valuation. And I hope this was clear. All right, let's move to question number 27. Question number 27, the question says, what are some flaws with precedent transaction analysis? So transaction, this question is about valuation methods in finance, especially precedent transaction analysis, which is one of the three main valuation approaches used in investment banking, alongside comparable companies analysis and DCF. So comparable companies analysis, we have discussed previously that we are pricing in that. And what actually is a precedent transaction analysis is we looked into the past merger and acquisition deals for companies that are similar to the one you are trying to value. And the idea here is that if a company was acquired for, let's assume 10x of multiple, 10x of EBITDA, and our company is similar, then our company might also be worth around 10x of 10x of EBITDA. It's based on real market data, what buyers have actually paid, so it can give a good sense of market value. And the flaws and the limitations with this is the answer you just gave um, here is it lists only two main flaws, which are both very important. So let's go through them cleanly. Uh, Past transactions are rarely 100% comparable. Uh, Even though you try to pick similar deals, no transactions are ever exactly the same. And why not? Because transaction structure, company size, and market sentiment and timing matters. And transaction structure means some deals include stock instead of cash, earnouts, and special items that affect the price. Also, company size, large companies tend to have a higher valuation, lower risk, more stable, and cash flow, while smaller companies may be discontinued. And the third was market timing. A deal done during a market boom will have higher multiple than one in the downturn. So if you are using an old deal as a precedent, you might be comparing apples to oranges. So transaction structure, size of the company, market sentiment all have huge effect. And the second point here is the data on precedent transaction is harder to find. I mean, unlike public companies where data like stock price, financials, and market multiples are easy to get. Private merger and acquisition deals often don't disclose the detailed information, and the problem includes here is like many deals, especially for small private firms, are confidential. You may not know the exact purchase price, debt assumptions, or earnout terms, and the financial data of the target company may not be available. And as a result, your analysis might rely on incomplete or estimated data, making it less reliable. So getting the data for merger and acquisition is actually one of the biggest challenge. And because these are private companies, they do not have any obligation to report out these data also. So this is one of the major challenge, and because of this challenge, uh, our analysis might be incomplete, or we might be estimating data, making it less reliable. Okay, so let's move to question number 28. Question number 28 is the question is asking, two companies have the same exact financial profile and are bought by the same acquirer, but the EBITDA multiple for one transaction is twice the multiple of the other transaction. How could this happen? And the key point here to notice is that some financial profile, both companies have EBITDA. So here what the question is asking is the same financial profile. Both companies have similar EBITDA, growth margins, etc. So the difference in the multiple is not because one company is inherently more profitable or larger. The second point is that they have the same acquirer, the buyer is the same, so strategic motivations are similar, and EBITDA multiples are different. This means despite the above point, one deal is valued at twice the multiple of other. So the question essentially is asking if if the fundamentals and buyers are the same, why might one deal get paid at a higher multiple than the other? And let's understand the EBITDA multiple first, the enterprise value to EBITDA. We have discussed previously that enterprise value is, if we think about the ratio, the EBITDA multiple, the EBITDA multiple is enterprise value to EBITDA. So enterprise value is what the acquirer pays. It includes debt and equity, and EBITDA is the company's operating earnings. If EBITDA is same for both targets, then the difference in the multiples come entirely from the purchasing price. So the question is really asking why might the acquirer pay more for one company than the another, even though they are otherwise similar? And if we analyze the possibilities here, is the one process was more competitive and had a lot more companies bidding on the target. This means that if the multiple buyers are interested, the target can spark a bidding war and pushing the prices higher. This might be one of the case. This might be the first case. And same EBITDA, but more competitive auction leads to higher enterprise value, hence higher multiple, because the multiple is driven by enterprise value to EBITDA. So if we divide enterprise value by EBITDA, so this the first question explains this possibility. So the second point explains one company had recent bad news or a depressed stock price, so it was acquired at a discount. Yes, this can be the possibility that if the target has negative news, weaker outlook or depressed stock price, the acquirer can pay less than its fair value. And even if EBITDA is the same, enterprise value is low, reducing the multiple. So discount due to perceived risk explains the difference, because in the other company, as according to this point, there was more risk in one company. And the third point here is that they were in the industries with different median multiples. So this means that if companies are financially similar, uh, industries have different typical valuation range. So, and some sectors like tech and software have higher multiples due to growth potentials. Others like manufacturing and retail have lower multiple. But in this question, both companies are being bought by the same acquirer. So the industry difference may not seem obvious, but if the companies belong to different sectors, the acquirer may still pay based on the market standard multiple. And here in the question, they are not saying that here the question is saying that they are exactly same profile bought by the same acquirer, but they have not discussed about the industries. But if companies belong to the different sectors, the acquirer may still pay based on the market standard. And this is a valid reason uh, in general merger and acquisition scenarios, though less applicable in if the acquirer is the same and both companies are in the same sector. And the key insight here, after understanding the question and the answer, what we get here is that even when two targets have the same financials and buyer, they have same financials and the same buyer. The EBITDA multiple can differ entirely because of the deal specific dynamics like target specific risk or news, target specific risk or news in the second point, and the industry norms also. So in this case, the question is testing your understanding that enterprise value to EBITDA multiples are not purely about financials. They are also influenced by deal context and market conditions. So just understand this thing that this enterprise value to EBITDA will be influenced by the deal context and the market conditions also. And even the identical financials and the same acquirer, EBITDA multiples can differ due to competition in bidding process, target specific risk, and industry specific norms. So let's move to question number 29 now. Okay, so question number 29 is asking, okay, let's understand the context here first. The context here is EBITDA, EBIT versus EBITDA. Why does Warren Buffett prefers EBIT multiples to EBITDA multiples? And when analysts or investors value companies, they often use multiples like EBIT multiples, enterprise value to EBIT, or EBITDA multiples, enterprise value to EBITDA. These metrics are used to compare companies' operating performance and cash flow potentials. And the difference here between EBIT and EBITDA is the earning. EBIT represents earnings before interest and taxes. EBIT represents earnings before interest and taxes, and it includes depreciation and amortization expenses. So we have subtracted depreciation and amortization expenses. So it includes depreciation and amortization expenses. And EBITDA, it represents earning before interest, taxes, depreciation, and amortization. It excludes the impact of depreciation and amortization. So EBITDA shows profit before subtracting depreciation and amortization. It looks higher because it ignores these cash expenses. And so Warren Buffett's criticism of EBITDA, so he dislikes it because it ignores the reality of capital expenditure. The actual money comes, the actual money companies must spend to maintain and grow their assets like factories and equipment. And hence, he once there was the Warren Buffett criticized EBITDA by saying that does management think the tooth fairy pays for capital expenditure? And since then, Warren Buffett has preferred EBIT over EBITDA. And in other words, ignoring depreciation doesn't make capital expenditure disappear. If a company's equipments wear out, it must spend real cash to replace it. Even though depreciation is a non-cash expense in the income statement. Uh, so EBITDA gives the illusion of strong cash flow, even in businesses that consistently need to reinvest heavily in equipment and assets. And why EBIT is better in his view is that although EBIT still doesn't subtract capital expenditure directly, it does include depreciation, and the depreciation is linked to capital expenditure. So when a company buys equipment, uh, that cost gets spread over a time is depreciation. So when high depreciation usually signals high ongoing capital needs. And that's why Buffett prefers EBIT. It simply reflects the wear and tear and thus replacement cost of capital assets. So EBITDA, on the other hand, pretends that those costs does not exist. So the impact of depreciation and amortization. And in short, Buffett prefers EBIT over EBITDA because EBIT gives a more realistic picture of the company's true operating performance and capital requirements, while EBITDA can make cash-hungry businesses look deceptively healthy. So depreciation and amortization is the main reason, and we actually have to keep on reinvesting in the business. And EBIT takes into consideration the depreciation amortization, and EBITDA doesn't takes into consideration, and EBITDA reports out bigger numbers than EBIT. So the true numbers are actually represented by EBIT, not by EBITDA. Question number 29, we are done with it. Let's move to question number 30. So the question here is that the enterprise value by EBIT, enterprise value to EBITDA, and price to earnings multiples all measure a company's profitability. What's the difference between them and when do you use each one? all these three are valuation multiples that compare a company's market value to some measures of its earnings and profit. But they differ in what in the numerator and denominator, and that changes what they tell you and which one is and when which is appropriate. So if it's price to earnings, so market price cap, so market price, and it means that if in the numerator, if we talk about the price to earnings ratio, the numerator is the market price. This means that the value to equity investors only. So the price will only be valued. It will only measure the value to the equity in on. It will value to equity investors only. It will measure the value. If the multiple is enterprise value to EBIT, so it is talking about the enterprise value. And enterprise, if they are talking about the enterprise value, so it will measure the value to all investors, equity and debt. So we have discussed it previously also. The price to earnings, it will only be the market price will only measure the value. It will measure the value to equity investors only, and enterprise value it will measure the value to all investors, and enterprise value to EBIT also, because of the EV factor, enterprise value factor. So price to earnings reflect only the value to investors, and enterprise value to EBIT and enterprise value to EBITDA reflect the total value of the fund, independent of the capital structure. So the difference here is that price to earnings multiple depend on capital structure because it uses net income, which comes after interest expense. The company with lots of debt will have lower net income, and that will affect its price to earnings ratio. And when we can use this is um, if you care about the equity returns, typically for banks and financial institutions where interest income and expenses are core operating, I mean, they are core operations, not just financing, then you can use price to earnings ratio, and it makes sense there. So understand this thing that previously we have discussed that the interest component, if the if the ratio includes the interest component, it will reflect all investors. And if the ratio excludes the interest component, then it will only reflect the value to equity investors. And because the the main dividing factor here is interest. So interest is involved. Interest is actually aligned with debt. So if debt is involved, debt and equity are involved both. So those will be ratios where those will be the multiples where all of the investors are where the value is being measured for all of the investors, and only if the interest component is missing, then it will be only measuring the value for equity holders only. So let's move to uh, enterprise value to EBIT. So enterprise value to EBIT is independent of capital structure because it ignores EBIT. It actually ignores interest expense. And because depreciation and amortization, so it reflects the cost of using fixed asset, enterprise value to EBIT. So we will use enterprise value to EBIT when depreciation and capital expenditure are significant for capital intensive industries like manufacturing, industrial, airlines, and energy. If you want to capture real economic cost using those long-term assets. So we will use enterprise value to EBIT where the depreciation and amortization components are very high. And if so similar to EBIT, enterprise value to EBIT, enterprise value to EBITDA are also independent of capital structure, but it excludes depreciation and amortization. It is closer to cash flow proxy, though not a perfect one. And we will prefer using this multiple uh, um, for light asset businesses such as software, internet, or service companies, because the impact of depreciation and amortization will be very low. So there are no fixed assets. So here you do not want depreciation and amortization, which is non-cash accounting expense, to distort comparisons. So you can use that. So if some in simple terms, price to earnings is how much investors pay per dollar of after tax profits. After tax profits earnings, how much an investor is willing to pay for $1 of after tax profits. Enterprise value to EBIT is how much all investors. So this is equity investors and this is all investors. How much all investors pay for $1 of operating profit after depreciation, and how much all investors pay are willing to pay for $1 of operating profits before depreciation. So question number 30, we are done with it. And we are only remaining with four questions in this reading. And we will cover this in these questions in later readings, in the later lecture. And I hope this was clear. And if anything doesn't make sense, you can always uh, post it in the comments and I will be happy to answer that. Thank you. Thank you for attending the lecture.